It's not as if it doesn't matter who becomes the next president of the United States. It does. It's just that there's no significant relationship between the president's party affiliation and the returns to either equity or fixed income securities, according to the authors of a new study, What to Expect When You're Electing. Unlike other studies which typically examine, say, stock market returns and the outcome of the election, the authors of this study looked at security market returns relative to the political party of the president, the Federal Reserve's monetary policy, the year of the president's term, and the state of political gridlock. And what they found is this: investors should focus less attention on the party of the president and instead more closely monitor federal actions. Our analysis supports the notion that security returns are significantly related to shifts in Fed monetary policy, political gridlock, and the year of the presidential term, wrote the authors of the study. Scott Bayer, a professor at the University of Wisconsin-Oshkosh, Luis Garcia-Feju, an assistant professor at Florida Atlantic University, Gerald Jensen, a professor at Northern Illinois University, and Robert Johnson, a professor at Creighton University, watched the federal. In particular, the authors said equity investors, especially those that target small-cap stocks, would be wise to monitor federal policy actions, while paying limited attention to the party of the president. Consider, the Standard & Poor's 500 stock index SPX negative 0.94% was 11.7% higher, and the U.S. small-cap index was 25.63% higher during expansive periods versus restrictive periods. Clearly, the equity markets have prospered during periods when the Federal has maintained an expansive monetary policy stance, wrote the authors of the study. As for how you might invest now given the Fed's current policy stance, Johnson offered this: the Fed's current policy stance is neither restrictive nor expansive. It's almost indeterminate right now, Johnson said in an interview. The Federal has been giving mixed signals. You certainly can't say it's been a restrictive monetary policy given all the easing, but if you look at our long-term and short-term indicators, they have been at odds. According to Johnson, the study combined two metrics to capture the Federal Reserve's monetary policy. The first metric is based on changes in the federal funds rate. This metric adjusts for federal stringency in the short-term market. And the second metric is based on changes in the federal discount rate. This metric captures fundamental long-term shifts in overall monetary policy. Using both variables more accurately assesses whether the Federal is pursuing an expansive or restrictive monetary policy, Johnson and his co-authors wrote. In effect, if the federal funds rate falls month to month, the stringency metric is considered expansive. If the federal funds rate increases month over month, stringency is considered restrictive. Changes in the discount rate are used in a comparable fashion and identify fundamental shifts in the Fed's monetary policy stance, the authors wrote. At the moment, the indicators are not giving a clear sense of the Fed's policy. But one thing seems certain to Johnson. There is a very high probability that the Federal will be much more restrictive in the future, he said. The authors also said federal policy shifts should be viewed as potential signals of coming inflationary pressures. A shift to a restrictive policy stance should alert investors to higher future inflation and support the reallocation to securities that offer more inflation protection, such as commodities and TIPS, they wrote. Before you start selling your stocks, though, consider this. The restrictive policy might bode well or poorly depending on 1. The political environment, whether there's political harmony or gridlock in Washington, D.C., and 2. The political party of the next president. Assuming the Federal maintains a restrictive monetary policy and assuming gridlock in Congress, and it is safe to assume this whether you over or underweight large-cap stocks, small-cap stocks, corporate bonds, treasury bills or TIPS will depend on the political party of the next president, said Johnson. Johnson also suggested that investors use the table to make small tactical adjustments to their portfolio, rather than major adjustments.